whether it is liquidity or profit booking or maybe both, things have taken a hard knock in last couple of days. Is it too early to use the phrase that the fear of bears is back?
Yeah, probably it's just too early. I mean, the fact is that we've had pretty much a very strong momentum over the last several months. And I probably think that the kind of correction that has set in over the last few sessions is more like a pause in an uptrend. And I wouldn't even yet call it a correction. I would still probably think that this is basically a consolidation which is happening in the market out there, given the kind of run-up that we have seen and the fact that valuations have run up. So I think it's more a consolidation rather than anything else. And I'd probably still think that the uptrend is pretty much intact.
Nilesh, nobody is arguing with the macro. The macro is very favorable, which is inflation is low, liquidity is high, the case to invest into India from foreign investors, the narrative is at an all-time high. The challenge is that A, valuations are stretched, and B, markets have already started talking about FY23 and FY24 earnings. Isn't that a stretch?
It depends on what the perspective is. So if you're essentially a medium-term investor, then obviously you need to be focused on what the emerging scenario is going to be over the next 2 to 3 years. That's always basically the case. And it looks like, Nikunj, that after a very long time, we are seeing some robustness in terms of the macroeconomy as well as basically the growth outlook. Clearly, of course, there's no denying the fact that the next 12 months are expected to be a double-digit growth in terms of GDP growth. And hopefully that sets the platform for essentially a sustained growth thereon. So maybe we don't, of course, step into extended period of double-digit growth, but maybe 1 year of double-digit growth followed by a high single-digit growth, I think is fantastic. You're not going to see that in any other part of the world. And so to that extent, I think India's attractiveness, I think, is still intact and probably is even getting better with every passing day. Obviously, of course, the joker in the pack is going to be commodity prices, given that we are a huge importer of commodities, and therefore that has its own implications in terms of interest rates. But otherwise, I clearly believe that we remain a very attractive destination, and we will probably remain amongst the best growth opportunities that the world has.
Nilesh, commodity prices have gone higher and now I think it is hurting companies. I looked at the margins which HUL reported. Today I think Maruti also will feel the heat of the high commodity prices. Are we reaching that point in time where commodity prices are unlikely to sustain? Because if that is the change, then a lot changes for industrials and cyclicals.
Yes, clearly I think that is the big risk that we face as investors and we face in terms of our growth. And we have seen in the past that when India has witnessed high levels of growth, that has inevitably followed up by pretty high inflation as well, which obviously, of course, comes in because of high commodity prices. I still believe it's early days. If we really look at it, most of these commodities are probably at their 3-year or 5-year or maybe in 1 or 2 cases at a 7-year high. But I don't think there are kind of new highs in terms of commodity prices. Number one. Number two, I still believe that strong franchisees and producers still have the ability to take price hikes in terms of their end realizations. So the names which you mentioned, I still believe are favorably placed to take the price hikes. Some of them have started to take price hikes and are able to yet pass it on to consumers. The big challenge, of course, is that maybe we've reached a level where we're probably reaching close to a threshold saying that maybe, yes, a bit of more increase in commodity prices is fine. But I think maybe another 5-10% increase in commodity prices from here, I think will essentially start to hurt, because beyond a point, producers will not be able to pass on those hikes, or you will feel a pushback in terms of consumer demand. So clearly, that balancing act will probably go on for maybe some time to go. I think right now we're probably just towards the outer limit of that comfort zone in terms of commodity prices, and maybe an inching up of prices from here will definitely start to hurt. So that's, of course, we need to keep one eye on how inflation and how commodity prices behave.
Nilesh, a lot of the pressure continues to be on the financials. Even though earnings have been pretty much in line or in fact positive, what's making the market still so jittery when it comes to the financials?
Couple of things. One is, of course, directionally, one always sees that whenever there is some bit of, looming inflation and things of that kind, we see that correction happening in financials. Though, of course, I still believe it's early and that may not be the prime or the solitary reason. The big reason, of course, is essentially the uncertainty around, recognition of NPAs. Given that there are certain directives in terms of the moratorium and the recognition of NPAs or the asset quality issues, I clearly believe that's going to be the single big event, in the very short to medium term, and that's something which needs to be out of the way. So clearly that needs to essentially kind of be in a way sorted out. I think once that sorts out, you clearly see essentially markets taking a more normal view of asset quality and its implication for banks. So clearly, till the point of time the moratorium-related issues don't get sorted out, they could be under some pressure. Number one. Number two, of course, they've had a fantastic up move. Some of these banking names are up 40-50%. The frontline banking names are up 40-50% from their lows in October. So you clearly see that there is a lot of room for profit taking for people who want to essentially take some money off the table. So that's the second big phenomenon. The third, of course, I still think is that basically spreads. I think the competitive intensity is going up. Clearly, earlier, there were just two leading private banks, which were essentially, in a way, pretty much calling the shots and leading the party in terms of credit growth. But now, essentially, some of the other private banks and some of the PSU banks have, in a way, pretty much set their house in order. They are well capitalized. They've essentially recognized most of the problems relating to asset quality and are essentially well set for growth. So clearly, competitive intensity is going up. What is getting reflected in terms of the interest rates for home loans is clearly a manifestation of the competitive intensity which is going up. So that essentially is also leading to some bit of corrections. I probably think that it's a combination of these three things which essentially is setting the stage for correction in financials and especially banks.
Okay, that's on the financials then and what we're tracking over there. In terms of really, whether or not we can see much of a push coming this time around on the back of the budget, Nilesh, are you hopeful of seeing any major stimulus, or do you feel that it's largely going to be incremental?
Don't expect it. I don't expect any major stimulus coming in from the budget. Honestly, if there's one hallmark of this government, essentially, is that they've been fiscally very responsible. And clearly, the number around the fiscal deficit has always been a top priority for this government. So to that extent, I really do not expect any big bang stimulus from the budget. But surely, I expect a lot of policy initiatives around growth, around the infrastructure space, especially physical infrastructure. And third, of course, is a lot of initiatives which will further set the stage for India to be more digitally ready, which means that basically for the digital infrastructure to really play out, which includes things around 5G and ensuring that essentially, data reaches essentially the last mile as far as India goes and into the most remotest part of the country. So clearly, these are the three big things which I think the budget is going to essentially spell out. I also think that the budget could spell out really a 3-year game plan, given that the government currently now has effectively 3 years left. So I clearly believe that it will set the stage what the agenda is going to be in terms of the economy and economic governance over the next 3 years. So I still think that it's going to be more around, initiate, facilitate and enable growth. Firstly is, of course, overall aggregate growth. Second is essentially physical infrastructure. And third, of course, is digital infrastructure. So these, I think, are essentially going to be my expectations around the contours of this budget.
Sure. Nilesh, since we're talking about the budget, disinvestment was a big theme last time around as well. And unfortunate as it may be, because of the pandemic, the process got a little bit more derailed. While we've seen, a couple of privatization and disinvestment chatter really pick up ground, do you hope to hear something material in the budget speech this time when it comes to disinvestment of PSUs?
I'm not entirely sure. Of course, there seems to be a lot of buzz in terms of, some new policy framework around privatization or around disinvestment. My sense is that the budget essentially will just probably go into the quantitative part of it in terms of that what is it that the government intends to raise through disinvestment and privatization. And my sense is that that number is going to be huge, given that essentially this year not significant has happened, and obviously because of the circumstances. So my sense is that the target for financial year 2021-22 is essentially going to be a combination of the target of FY21 plus FY22. So my sense is that that number probably is going to be significantly higher than what we have seen in the past, number one. And number two is that that number is going to also be encouraged quite significantly by two factors. One is that the government has made significant headway in terms of the progress and the modalities of divestment or privatization, which means either identifying the units to be privatized or choose the modalities of privatization. So to that extent, that's going to be very encouraging for the government to significantly up the number. And the second important factor is that, a big bang divestment of something like an LIC, where even a 10 or a 20% kind of a stake sale is going to mean a lot in terms of the numbers or the quantitative basically target. So my sense is that rather than laying any contours of privatization, my sense is that the budget will primarily deal with a significantly higher target for the coming financial year in terms of the proceeds from disinvestment and privatization. In addition to that, it's quite possible that this budget could, of course, hint at or directly make references to corporatization of various state-owned undertakings or various government-owned undertakings, which are more like today departments of the government, but essentially the budget could basically hint or directly refer to corporatization of this. For example, railways. Now, of course, that's huge. But something like basically, corporatization of the railways, which means converting the railways from a department of the government to essentially a independent undertaking, a corporate undertaking itself could be a huge signal in terms of the government's intent going forward.
Okay, back to markets and where we've bled quite a fair bit. In fact, sub the 13,850 level now for the Nifty futures. All sectors in the red as we speak right now, and the breadth as well quite dismal with just 33 stocks standing to the advances. Rest all 108 F&O names in the decline. BOB is now down 7%, United Spirits down 6.25%, PNB, NALCO, Canara Bank. These from within the liquid universe are taking the sharpest knock, and it's private banks really, along with some PSUs, which are really taking a sharp knock when it comes to the Nifty names. HDFC Bank fallen 2.6%, Kotak Bank down 2.25%, financials like HDFC, SBI down 2% as we speak right now, and metals as well as a cluster are not doing all that good. In fact, even technology, much unlike was the case yesterday, that's also giving up some of their gains. Nilesh, do you buy this decline just yet? From a longer haul perspective, do you think we've fallen enough to buy the IT farmers of the universe?
Absolutely. I think we're extremely constructive on both pharma and IT. Of course, one has got to be selective, but nevertheless, I think pharma and IT present again a good entry opportunity post this correction, and honestly we expect them to relatively outperform as businesses and consequently as stocks going forward. So the way we're really seeing the overall positioning, I think clearly there are two pockets. One is of course pharma and technology services, which are more global plays, where the demand for their products and services is pretty much non-discretionary. And so to that extent, there's a relatively higher visibility in terms of basically growth going forward. On the other hand, what we think is that in terms of the domestic economy, clearly believe that some of the discretionary space, like, for example, auto or related sectors, and second is, of course, real estate and property and the connected sectors, including building materials, are again, fantastic pockets of growth and fantastic pockets of opportunities. So clearly believe that on a combined basis, these four opportunities, I think, need to be looked into in the current times. Their last quarter earnings have been relatively fine, and we expect these businesses to do well over the medium term. So any kind of corrections really creates essentially an opportunity to either enter or essentially add up to your existing positions.
Are you still sticking on to your old favorite, which is LTTS?
Yes, Nikunj, that's something which we still continue to own. And we like what they essentially do in terms of the ERD space. And clearly, I think they have the benefit of essentially dealing with a low base, given that the last 4 to 6 quarters have been relatively tepid or weak for them. And given some of the deal wins that they have announced, maybe the forthcoming quarters could be good. But I think, irrespective of how the business shapes up in the very short term, but I think, clearly, I think it's a good stock in the entire, tier 2 kind of space, and especially in the niche segments.
Nilesh, I looked at numbers from Asian Paints and they were nothing short of breathtaking. In the pandemic era, this is the post-festival season sales. They've given a volume growth of 9-10%. HUL numbers also, no problem. Fabric care business and other businesses have stabilized. My question is that have FMCG stocks corrected enough? And are they getting ready for a good 2021? Because the consumer is back and the consumer demand is back. Somehow I don't see that excitement in these stocks now.
Yep, so Nikunj, I think all these stocks, the consumer pack essentially, the consumer staples pack especially, are coming out of a period of very extended outperformance. And I think a lot of the outperformance has been coming in because of the fact that, rest of the economy was not essentially growing to that extent. And if I were to kind of look at, say, the last 10 years, which has essentially been the decade of the consumer staples, broadly, if you look at it, HUL as a business has been growing at, say, 10-11%, but the stock prices appreciation has been more like 20 to 24%, which means that significant part of the returns have essentially come in from a PE re-rating, so to say. Now that was fine because some of the other pockets, especially the core sectors, the infrastructure sector, capex cycle, investment cycle, essentially were pretty much dead or moribund for the last decade or so. But that probably is set to change, and we might see some of these pockets begin to do well. One example, of course, was real estate and building materials and all of that as well. So I think once you see some of these other businesses, other sectors start to basically gain momentum in terms of growth, essentially consumer staples may no longer be a very preferred or a pretty much like a automatic or a choice by default. Yes, of course, investors will continue to own them, but to kind of be significantly overweight on them, I probably think that may not be the case going forward unless valuations kind of normalize still further. And that can happen that maybe for the next year or two, these stocks, or maybe as a sector, the consumer staples may just remain very sideways. Despite the fact that earnings grow for them at 10-12%, so that basically valuations catch up for them. But in the process, there will be other parts of the economy which might do better, grow at a higher pace, and you might see incremental liquidity go into those kind of sectors and those kind of pockets. So my sense is that maybe the earnings will grow at 10-12% for the consumer pack, but maybe as stocks, they may just kind of be very sideways for the next year or two.
Nilesh, we started with budget. Let's wrap up with the budget. 2018, the market got hit because of LTCG. Then the next budget, there was taxes on dividend. Then the follow-up budget, taxes on buyback. Anything else which could surprise or disappoint the market? Because frankly, for HNI investors, the direct tax structure has been going higher. The curve has been steepening only. And from a market standpoint, the taxation structure for direct equities and dividend only has increased.
Yeah, Nikunj, so that honestly will remain a concern. And especially if, there is one more kind of, there is buzz about basically some cess or a tax around COVID. And, so if something like that gets imposed, or there are talks of maybe some special tax from capital gains for essentially the larger investors or entrepreneurs who are exiting the business, and if there's a one-time special tax on that. Any of these kind of things essentially are will be negative from a sentiment point of view. So that's something which I would probably say that it's better if that something like that doesn't come, because that can really, in a way, spook the sentiment and add further momentum to essentially the kind of downside in the markets. I think this is a stage, or this is a time where I think it's best left that the returns or the savings or the investments are not incrementally taxed. And it's best left to individuals to essentially decide the allocation and leave them with more ammunition to kind of plow back into the markets or into their savings channels or into their investment pools. So my sense is any other new form of tax or incremental tax or raising taxes essentially will be negative in terms of sentiment.
All right, Nilesh, appreciate your time. Thank you for joining us, and we look forward to our engagement on the budget day.